As the goods and services tax regime neared 1 year of implementation, the High Courts, the Authority for Advanced Rulings or AAR, and the Revenue Department got busier, thanks to the litigation that experts say pertained to 3 key areas: transition credit, uncertainty on the law that is prompting taxpayers to approach the AAR, and allegations of profiteering against manufacturers. We spoke with Badri Narayanan, partner at Lakshmi Kumaran Sreedharan, on what's causing disputes on the transition credit front. For a smooth transition from VAT, excise and service tax regime to GST, the government had allowed taxpayers to avail input tax credit on transition goods. For instance, a manufacturer could avail of credit for goods sold in the GST regime but on which VAT had been paid. The closing balance of credit in the books of companies was also permitted to be used against GST liability. To claim this transition credit, taxpayers had to file Form Tran 1 before December 2017. It is the amounts claimed in this form that the tax department is now contesting. Badri Narayanan, partner at Lakshmi Kumaran and Sreedharan, points out.
There are some lacunas in the transitional credit provisions itself. I'll give you a couple of them. One area where there's a lacuna is with respect to transition of capital goods credit. Okay. Under the old regime, capital goods credit was not available to you if the output tax was 0. Okay. Obviously, if it's exempt, then you cannot get any output tax with respect to those supplies. But in the new regime, these supplies which are being manufactured or being generated using these capital goods are now taxable. Okay. So now the assessors are going and saying that while I was not eligible for credit in the old regime with respect to these capital goods, it's wrong for you to deny at least a proportionate portion of the capital goods credit in the new regime when I'm actually paying taxes on the output.
So earlier there was no tax on the output?
There was no tax on the output. Okay. Now in GST you are imposing a tax, but you're not giving me the proportionate credit of capital goods. That's one area. This is especially more pronounced in area-based places exemption, where there was clearly an exemption and now it's suddenly become taxable and you're having to claim refund. But again, you're not giving them the credit with respect to the capital goods which they previously had purchased and they had taken, but they are not able to claim it because of that. Because as you know, the transitional provisions were based on a rule that you'll be able to take credit in the new regime if you're eligible for credit in the new regime and the old regime. That was the general rule of thumb which they had used. Okay. And if you apply this, it breaks down the capital goods regime, but it's not fair. So those provisions are getting challenged with respect to capital goods. Another interesting area is that section 140 provides for transfer of Senvat credit, which was there in your earlier regime, into the new regime. And Senvat consists of variety of taxes, the major ones being excise duty and service tax, but it also included variety of other taxes such as education cess, education cess, and so on and so forth. Under the new regime, because there is no cesses as such being provided,
they got subsumed
in the entire GST regime, the department took a view that education cess will not be available as transitional credit to you. Okay. But under the old regime, the Senvat definition specifically provided for education cess as being part of your Senvat. Therefore, now the dispute comes that what's the meaning of the word Senvat under GST? Okay. Whether it will include education cess or not. Those are interpretational issues.
How easy it is to calculate this credit? Because education cess is only a part of the entire taxation that the goods were subject to.
But if you are an automobile company, right, considering how big your output is, okay, this number in absolute terms can be quite big. Okay. So many companies have seen these are absolute numbers. Also, many companies in the initial months, you will know that many of them saw their rates go up because of 28% being the applicable output tax till November when the things got changed. And therefore, that credit is extremely valuable for them to be able to utilize it towards their output. Otherwise, the working capital blockage which is there. So, transitional credit, according to me, is an area where largely now the battles will start with respect to GST.
The litigation is also on account of calculation errors and technical mistakes, Badri pointed out. But in spite of it all, if the tax department's view prevails on law and on calculations, it could mean additional GST liability for some taxpayers. In Mumbai, by Upadhyay.